Thanks for listening to The Derivative. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.
Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world.
We started noticing that there's this dislocation with excess variance in the front of the term structure, and the market carried this sense of reflexivity based on a few things. One would be this dealer gamma hedging. With the increase in derivative exposure, that's become so much more prominent. So the reflexivity that you have in the front of the term structure has been so much stronger. And then I think the second main thing is just this shift towards systematic investing by some of the pension funds and some of the other large money institutions on the buy side. So it really had us understanding that, well, when the market makes these moves, it makes these moves very violently, and it makes it very quick. So what we understood was, well, there's a natural mispricing when you think about kurtosis and you think about the tails in the listed option space. So we primarily positioned the book to be long gamma within 2 week to about 2 month listed options, and primarily we're buyers of very cheap skew and cheap wings in those areas. So we're the crazy guys buying tails.
Ladies and gentlemen, in this corner, we've got Kris the Kid, the Duke of Dispersion, the Trinidad Tornado, the Ambrus Assassin, Kris Sidial. And in the other corner, just me, sorry. But having some fun with your boxing hobby there. Hope that's okay, Kris.
Yep, all good.
Do you have an actual ring name?
No ring name, no fighting name, none of that.
The Duke of Dispersion? Maybe you should take that one on.
Gonna have to think about that one.
But sorry, more officially, we're excited to finally have Kris Sidial, Co-CIO of the Ambrus Group, on by himself, finally, to shed some light on how he approaches the market. We've had Kris on twice before on the pod, talking the GameStop craziness with Jim Carson, and once talking the election craziness with Matt Laviolette of Breakout Fund. So finally get to dig into your background and how you run the Ambrus Group trading. So again, welcome.
Yeah, thank you for having me. As always, it's a pleasure, and it's good to be doing this in a time on a Friday evening where only the true traders enjoy it, you know?
Yeah, I was hoping to get you like in Friday casual without the tie. Still never seen you besides your Twitter post where you're in the gym without the tie on.
Yep.
It's good. And you're in your offices in New York?
Yeah. We're in the office. It's hot here. I got to put on the AC. It's starting to sweat up in here, if you guys can see.
How New York back to normal, or what percentage do you give it on normalcy?
I would say it's primarily back to normal. For where I'm at least. You have a lot of places aren't even requiring the mask. A lot of gyms are just straightforward now. A lot of the out to eat dining is straightforward. So yeah,
I've heard in Chicago here they've kept some of the COVID stuff where they shut down sections of the street and there's all the outdoor dining in the street. So some of that leftover from COVID has been good in terms of restaurants. I think they're doing the same in New York.
Yeah. You're starting to see that quite often. So, I mean, I just think it's going to be interesting to see, how some of the businesses will handle it in the fall time. If, anybody will even care about it in the fall time at all,
Yeah, we'll see. I think they will. And your family immigrated from Trinidad and Tobago. So tell us about Trinidad. You've only been back a few times?
Yeah. So I've been back there a couple of times, but it's a beautiful island. It's in the Caribbean. Um, and I mean, I personally enjoy the cuisine, maybe because I'm biased because, my mom's from there.
Yeah.
Uh, but yeah, I personally think that it's it's a nice area to visit if you want to take a trip down in the Caribbean. Um, but yeah, I enjoy the cuisine and
Done. What's the cuisine like?
curry, curry.
Curry. Yeah.
Yeah. So I think one of the most interesting things there that I ate was actually shark. There's
Yeah.
something called bacon shark on Maracas Bay, and literally they cook shark and I think they kind of like fry it and they put it in this type of like baked type of bread and you eat it collectively. The real Trinidadians are probably laughing at me because I can't fully describe it, but
Yeah. All right. I want to try it. I'm sure there's one. I'm sure there's a restaurant in New York. I'm sure there's one in Chicago. If we looked hard enough.
yeah.
And so you mentioned just now your mother, but you also, I was read a tweet on Father's Day you sent out. I'm going to read it real quick for the listeners. You said, growing up, I didn't have a father there to give me guidance, life advice, support, etc. Those of you that do, don't take it for granted. Bless them and show your gratitude today. Because a lot of kids that grew up in those low income housing areas would kill for a real dad. That was super touching. So a few things there. Like one, thank you for that. I called my dad immediately upon reading it. I was going to anyway, but I got right on it. And as a dad myself, I'm like, that's heavy stuff. Brought a tear to my eye.
Yeah. Yeah. Go ahead.
I was just gonna say, like, that's the real you, right? That's the real you coming out on Twitter there, which you often do. So I applaud that. But does there you ever get any blowback for being kind of too open and too honest on there?
Yeah. I mean, I think when you develop a pretty large following on Twitter, you're always going to have people that are going to say things back and forth. But I enjoy the trading community. I enjoy the people that are very straightforward and honest and are out there. I mean, we live in a time where you're able to interact and engage with PMs who manage literally billions of dollars, through Twitter. And even though I'm a younger manager, I think people appreciate it as well that I'm open and outspoken and just authentic about who I am and where I came from. Not really shying away from that, but more so embracing it so that other people who did kind of go through that passage or are going through that passage, they could relate, and empathize in a way.
Yeah. And so tell us a little bit more about that passage.
Yeah. So growing up, pretty interesting route, not the typical Wall Street route. As growing up in Brentwood, New York, low income housing area or whatnot. Not really the best area and not really the nicest place to like network and really build those type of connections to get yourself in Wall Street. So growing up was a little bit tough. It was a very tough community to live in and try to be ambitious because the community didn't really embrace things of that sort. So you had like gang violence, drug trafficking. That's really what the town was notorious for. But I think my mother always like drove home the notion of actually holding an education. So I was always like a little bit of a nerd growing up, because I kind of embodied all the things that she would say. So
In all subjects or just math or what?
Primarily math, but I was a well-rounded student. But my math ability stood out. I was part of the math Olympiads, and I think that I always thought about life in a statistical frame, as a flawed sense of thinking because as you're younger and when you're naturally thinking about things like that, you think everything is Gaussian. You start looking at the world in a closed-ended form. But yeah, kind of made my way, graduated high school, and went to LIU, which that was where I really first got into trading, and kind of found my passion through there.
Through a program or just through talking with different kids and getting on it?
No, I had this interest because again, I thought of things in a type of Gaussian type of way, and I was into sports betting. I was very heavily into sports betting, even though I didn't really have any money, but my close friend and I, we would put our money together and we would gamble on games, and I would use statistical analysis to try to break things down. And then I was an accounting major, and I put together this thesis of applying it to the market. And as every younger quant kind of gets into, you fail, right? So
Yeah.
lost a ton of money. Not a ton. To me, that was a ton, right? $3,000 back then when you're a broke young kid, like that's a ton of money.
Yeah.
But went through this a few times, and then eventually I had this one of those like kind of cool stories where I had a few $1,000s and I turned it into 50,000, and then I learned some of the lessons along the way when I gave back half of that. But I developed a core strategy, right? I developed a core repetitive strategy that took advantage of some sort of a dislocation, but the mentality that I had behind it wasn't structured well enough as a trader to fully play that out. So what would happen would be, I'd make money, and wouldn't adhere to the trading rules, and I gave a good amount back. But those are lessons that I kind of took and learned throughout my career as a trader.
So the sports gambling, you were using stats. You weren't just saying, oh, we're going with LIU. Now, if I'm really impressed, are they like the Blackbirds or something, or I used to follow their basketball team in a weird pool I was in. What's their mascot?
Yeah, so it's weird because I went to CW Post, which is technically like LIU kind of took over. So
got it.
Yeah, but LIU Brooklyn's D1. So
they're basketball team.
Yeah. When people ask about, I guess college sports, I lean to Penn. So I'm finishing my master's at the University of Pennsylvania. So
yeah,
even though they're not too great either.
Yeah, the Quakers. I know that one.
Yeah.
Our Union football coach came from there, right? Yeah. And so then you started touching on the trading, and then from there on, you're like, I got to get to Wall Street. This is what I want to do with my life. Getting out of Brentwood.
Yeah. So, I think I had this real passion towards it. I was really obsessed with it. I mean, Friday nights, Saturday nights, you could ask my close friends directly. You couldn't get me to get out the house. Like, I was obsessed with reading all these type of trading books, like the very old school trading books too, like Market Wizards, Way of the Turtle, Reminiscences of a Stock Operator, like, candlestick analysis and stuff like that. Like, I was just really in love with the game. And I think I had a finance professor that really acknowledged that. And he noticed that because I would spend hours just in his office, just talking to him about trading and market sentiment and ideology. And he was a Chinese value investor, funny enough, just completely different from, what I do.
Yeah.
But he pretty much told me, he was like, you should take a shot at this, and kind of see where it goes. So I was really trying to apply because I was like, all right, I'll give it a shot. I know, I'm coming from a non-target school, so it's going to be tough. I had a really good GPA though. But it was tough. It was tough because although in my heart, I knew that even some of the other kids coming out of the Ivies, I was a better quote unquote trader because I had more knowledge about, the market itself and trader psychology and how to apply it. I knew I was at a big disadvantage. And my coding skills during that time were just like, okay, it wasn't like amazing, right? So you're talking like 2014 now, which is when the industry started gravitating more towards like, the quant-based pure coding. So yeah, I was doing everything I could to break in. When I tell you I was sending out like 100 emails a day, reaching out on LinkedIn, I was doing everything I could to network. And I know that I told this story on another podcast, but there was a couple times where I would like stalk a few PMs, where I would literally just see the guy on LinkedIn. I would kind of figure out, okay, what office is he in, and kind of wait outside. When he came out, I'd have my track record. As I said earlier, I did fairly well trading my senior year. I'd extend my hand. Hey, my name is Kris Sidial. I returned X amount, thinking that they would be impressed by that or whatnot. And then yeah, I really tried to pitch them that way.
I wish you'd videoed that. I'm sure there were some guys who told you to F off and some other unkind words, right? Or did anyone take it? Or some might have just taken it and thrown it in the next trash can?
Yeah, nobody was really receptive towards it. There was a couple times where, I had people kind of humor me, and you could tell they were humoring me because, they were smiling or whatnot. More so looking at this like, oh, it's cute, but
Yeah.
not really taking it serious. So yeah, there was a lot. And then there was a few guys that were just super dismissive. Like, me personally, where I'm at right now, I would never be that dismissive to a college kid who's really trying to show some sort of initiative towards something. But yeah, it was fun. Looking back on it now, I'm actually glad that things worked out that way.
None of that worked. Like, you showed all that hustle, but really none of it worked, right?
None of it worked. None of it worked. I had my first real breakthrough in the most peculiar way. So I was searching for jobs, and I had noticed there was a job on Indeed that got put out 15 minutes prior. And it said something about junior trader. So I literally it had a number on it, which is pretty odd because some of the Indeed things don't have the numbers on it. So I literally called, and it was this old man who was on the phone, and he was very standoffish a little bit. But I'll finish the story, and you guys will understand why. But pretty much, he ended up hiring me, and this individual was one of the guys that helped started the CBOE directly. His name is Bob Cantor. So here I am, just by luck, I ran into one of the old veteran volatility traders.
Yeah.
Right. That I had no clue that this is who it was going to be. One of the original guys that was trading in the pit, and pretty much I used to go to his house out in the Hamptons every day. I used to drive like an hour and some change out there to, trade under him. So I was his
nice house.
Yeah, really nice house.
But yeah, I've talked about this on other pods too. And to me, it's like Chicago versus New York. Like Chicago and the trading pits there, if you were hungry, even if you were big, they might just grab a guy because he was tall and built, and they'd plug him into the pits and teach him what he needed to know.
Yeah,
right? You didn't even have to have finished high school.
Yeah.
Versus New York was a little more like you needed the pedigree, you needed the referrals, you needed the background. So yeah, it's funny. I don't know if he was a Chicago guy or he just ended up in Chicago to start that. But yeah, we've talked about that before with Jason at Mutiny and whatnot, of like that Chicago versus New York dichotomy. So it sounds like you got a little bit of both.
Yeah, it was definitely a cool mix. I mean, looking back on it now, it's funny because he held 2 interviews, and so crazy. We held 2 interviews in a Starbucks in Southampton, and both interviews were 6 hours long. 6 hours, I kid you not. It was 6 hours with me and him just going back and forth, and him, throwing out certain things at me and asking, why should I hire you? And what would you do in this situation? And kind of listening to his stories, right? A lot, like a good amount of it was listening to his stories because he was an older gentleman. But yeah, I learned so much under this guy. Just the mentality towards trading itself, looking at volatility from, that perspective.
What was the main strategy there?
So it was pretty much equity vol. It was equity vol. He was running a few overlays of relative value in the equity vol space. He would also look at certain things, special situations like earnings events and things of that nature. But he used this word anomaly a lot, and he was writing a book. I'm not too sure if the book ever came out, but he used the word anomaly quite frequently, and it would always be about the tails. Funny enough, the way how life has it, almost a decade later, here I am running a tail risk hedge fund. But that mentality towards always being fixated on the tails was something that, I embodied later on.
And then from there, you ended up at BMO?
No, so I actually went to Chimera Securities on the prop desk for a little while. So, had a good amount of experience in understanding, trading order flow on an intraday base. So it had you thinking about things as a pure trader, where you're looking at routes, you're looking at certain things coming through the ECNs, you're understanding flow, you're understanding where certain algos have their stops, where other larger interactive agents hold their stops. And, it was a good experience in understanding really trading flow. Then I went to Xanthus Capital Management, a small buy-side equity hedge fund. They were doing things that was somewhat a flavor of stat arb, where they were focused on like earnings. So really understanding that component of the game. And then I went to BMO. I spent 3.5 years at BMO. Most of my time there was on the exotic derivatives and listed options desk. And that's where I would say I became like a complete trader, where I got the knowledge of understanding truly trading prop, buy side, obviously being under Bob for, the amount of time that I was, and then being at BMO on an exotics desk and understanding how to truly hedge off, $1 billion book in exotics and, listed options from a market maker standpoint.
So let's talk through some of those terms real quick. So just buy side, sell side. Explain it to the listeners.
Yeah, so the buy side is basically guys who are looking to make speculative decisions, right? So they are looking to generate some sort of a profit based on the trading directly. So if I'm a buy side guy and I am buying Apple, I want to make money because Apple stock is going up. Sell side guy is a little bit different. They want to make money off of the flow. So you'll have sell side research that gets put out. And the reason why sell side research gets put out from these large banks is because it incentivizes the buy side guys to trade more. And what happens when they trade more is, well, obviously, when you're talking about voice trades, it's you run up commissions with the banks, and the banks are able to take the spread and the difference of the trade. Yeah. So the banks make money. Sell side makes money when the clients trade more. Buy side makes money when the positions work in their favor.
I always still get confused on that. I feel like it just gets thrown around there and nobody ever stops to define it. And it's become a weird thing, right? Because you're like sell side, but originally it dates back, I'm sure, to like early 1900s of Wall Street banks. Like they were warehousing the stocks and would sell them to the funds and whoever that wanted to buy the stocks. Yeah. But essentially for these purposes, the buy side is hedge funds, prop shops, and the sell side is banks and market makers and brokers, right?
Right, exactly.
And so then talk through the exotics desk. Sounds very exotic.
Yeah. The exotics desk was great, man. I had big shout out to all the senior guys on the exotic desk over at BMO, because I learned a ton under those guys. I learned a ton when thinking about risk. When I first got there, the first book that was given to me was Dynamic Hedging by Talib, right? So immediately you start thinking about the true distribution, and you start thinking about, left tail type of events occurring. So it really kept that mentality to focus on the tails. And pretty much what it would be is, you would structure a deal. And in this low interest rate environment, a lot of exotic exposure has been like continuing to grow, right? So you've seen like a lot of appetite for like Phoenix auto callables, levered buffered notes, barrier notes, and that sort. So it's basically bespoke type of options, right? So it'll be certain type of options will be like bespoke and packaged into this like OTC exotic product, and it'll be distributed off.
And sold, basically the advisors are selling it to some end client in Wichita, Kansas or something. Saying, right, exactly. Hey, you can get this exposure to Apple. You cap your upside at 15%. The downside's capped at 10%, whatever the numbers are.
Exactly. So what the client would say, what the advisor would say to the client is, hey, I have a way to yield 7% or 6% a year. Would you be interested in that? As long as Apple doesn't drop 35% or 30%, right? If the knock-in is like 70 or something. And the client would be like, yeah, absolutely, I'll take that. So the client, they'll get together a bunch of like the appetite, and then they'll go to the trader at that large institution, which, could be BlackRock or something like that, right? Like one of these large institutions. And then they'll come to a bunch of banks, sell side banks, and they'll say, hey, we want to buy this particular note. Can we buy 25 to 35 million dollars worth of notional, or if you're doing real flow, 100 million or something like that, and then the bank that prices the deal the best will win the bid pretty much, and then they'll take on the risk. So let's say if you win the bid, you basically now structure the deal, you issue it off, and what you do is you go into the listed option side and you hedge off your risk. So pretty much that's really the nature of the game. So if you're on an exotics desk on the sell side, the way how you really make money is structuring a deal, kind of hedging it, getting it out there, and then hedging the book on the listed option side.
And would you actually structure the deals, or you're just working more on the hedging?
Yeah, so we would price them, right? So obviously, there's proprietary models and stuff like that that go into there that I can't speak on. But yeah, the traders on the trading desk would have an idea as to, okay, where should this be priced at? What should this be yielding? And you would kind of bake in a little bit of VIG, right? So
I'm sure a lot of bit of VIG.
Right, you're baking like 2.5 points worth of VIG or something on an exotic structure, but yeah.
Right, and so the bank's like, hey, the more of these I can crank out, I'm hedging it off. They basically have no risk, right?
That is the nature of the game, right? So the nature of the game is crank out as much of these as you possibly can and hedge off the book. At the end of the day, you make money by structuring these deals, printing them, and then if you could make money while hedging the book also, that's a win-win.
And what are they? Are they selling a straddle essentially? They're right. There's a knockout, so they're kind of selling a put down there, and the income's right exotically, synthetically. I'm saying, but like, how would you view the structure of what they were doing if it was a single structure?
So the client would basically be short Vega, right?
Yeah.
So the client is just naturally short Vega in those type of structures. So they're basically selling the downside put. So what happens for the institutions is when the knock-ins kind of hit, you as an exotics desk, you do well. But what happens also, and what could happen, is a lot of the structures are structured off like 5-year, 3-year notes and stuff like that. That's where a lot of these exotic structures get like issued off. But what could happen is if you have a scenario where your gamma in the front of the listed side that you're running gets out of whack, right? So let's say the market just tanks, where you have, a situation where correlations go to 1 and like all those knock-ins happen. So cool, the bank is well, but if it really gets over those levels and you're over hedged in the front of the term structure, then you're losing on all your hedges on the listed side, right? And obviously, because that carries a heavier gamma, you most likely are going to end up bad in that scenario if it goes over some of the risk levels that you're at. So as an institution, it's a fine line that you walk to. It's not like immediately as you hedge off the book, you guys are good, right? It's like, well, you're running a little bit of risk as well. So is the client.
How do you view that? And tons of this is still going on, right? There's tons of buffered notes and all this stuff today. Maybe even more than 5 years ago, right?
Definitely more than 5 years ago. Absolutely.
Yeah. So what can you simplify the risk those banks are taking? Are they trying to earn 2.5% and risking a 1 in 100 chance of losing 20%? Or like, what do those numbers look like? And I know it's not that simple, so sorry, but
yeah, I'm not too sure if I could truly accurately frame it that way. But I will say that there is an amount of risk that any institution, sell-side institution, takes on when they're kind of systematically printing exotic notes. And I will, there's a lot of exotic traders that will tell you too, they try to turn the business into a very systematic one, where you could go on the platform, you could kind of pick and choose what you want. And then, if the notional size is well enough, the bank will kind of structure it and print it. And there's a lot that goes into these deals that people don't understand. Like you have a lot of attorneys that need to be involved, and certain wording that comes into this, right? So really getting the term sheet correct, and you're basically systematizing all that and packaging it into one, so it could just be like a machine. Like, so there's some exotic desks that kind of have that approach with, they just want to boom, boom, get it out.
Right.
And
which makes me think of mortgage-backed securities and the whole industry doing, hey, let's just turn this into a machine and crank out as much as possible. But we all know how that turned out. So right. I'm not going to get you to say there's some huge risk of a blow up there, right?
Right. Well, one thing that is interesting is that that market is primarily driven off of this low interest rate environment, because the way how a lot of financial advisors look at some of these auto callables is like, okay, it has some sort of a yield to it, so this is another way for us to generate yield. So if you do have a scenario where yields actually start to go up, I'm curious to see how the US exotics market takes that, because I think it will probably be a little bit negative, because some people may just look at it and if we have a real move in rates, right? I'm not just talking about the 10-year at like 180, but let's say, whatever happens in a few years, curious to see how
350 in the 10 you're talking about.
Maybe, I mean, maybe, who knows, right? We look at that as impossible in today's age, right? Which is a horrible frame of thinking when we say to ourselves, well, yeah, you're crazy for thinking the 10-year could go to 350. Well, I mean, and that's the mentality that we have shifted.
That would be an anomaly, right?
Right, an anomaly, right? Whereas back in the 80s and 90s, we could have a 1% move in like a week or so.
All right, I think I have to have some exotic or some buffered creator on here to talk through all because what's the client's downside? If Apple goes down in our example, they could lose that full 60% on Apple.
Yeah, so they get knocked in, right? So it's
so then they have to own it. They're basically short the put. They have to own the stock.
Yeah, the way how the advisor will structure it on another side as well is interesting. There's other things that they could do where they're long this name, short this name. So it's a bespoke type of thing that clients kind of.
But wouldn't a client be better off just doing it themselves, right? Couldn't they do it themselves with listed options and not have to pay the VIG?
I think keep in mind, these are not clients that are generally like, $1 million. You're talking about like larger clients.
Yeah.
Which, they're probably not going to waste their time to go out and just sell downside put protection in the listed option space.
So learned all that on the exotic desk. And then finally said, I'm going out on my own, starting Ambrus group.
Yeah. So I think what started to happen was we started understanding that the market microstructure was changing. And this was something that myself and my 3 other partners felt very, very strong about. We started noticing that there's this dislocation with excess variance in the front of the term structure, and the market carried this sense of reflexivity based on a few things. One would be this dealer gamma hedging. With the increase in derivative exposure, that's become so much more prominent. So the reflexivity that you have in the front of the term structure has been so much stronger. And then I think the second main thing is just this shift towards systematic investing by some of the pension funds and some of the other large money institutions on the buy side. So it really had us understanding that, well, when the market makes these moves, it makes these moves very violently, and it makes it very quick. So what we understood was, well, there's a natural mispricing when you think about kurtosis and you think about the tails in the listed option space. So we actually decided to start up the Ambrus Group, which is a vol fund that's primarily focused on statistical outliers in the U.S. equity market. So we primarily positioned the book to be long gamma within 2-week to about 2-month listed options. And primarily we're buyers of very cheap skew and cheap wings in those areas. So we're the crazy guys buying tails. But to offset, the bleed, we have a few strategies that we run that are generally short vega in some sort of a risk defined type of way, where we're not just bleeding out 20% on an annual base, just systematically going out there buying tails.
And then it seemed like your thesis was proved entirely correct with like GameStop and AMC and even crypto to some extent, right? But we'll just stick with the listed securities. So GameStop and AMC, but talk through that. Like, I don't think you guys grab those names in particular, right? So the trick there is knowing which, right, of where are those outliers going to happen.
Yeah, no, so we actually did. So January was a good month for us because we were playing some of the right tail skew in some of those. So really what we serve as for our clients is sort of protection, right? So we have like family offices or institutions will look at us as their type of downside protection if the market kind of tanks. But we are also open to buying right tail skew in some special situations that we see kind of warrant it. So in January, when we started noticing some of these dislocations, my partner and I, we have certain models and certain screeners and whatnot that we use on the intraday base. And we were seeing the models kind of light up for these names. And I remember there was a few times where I was just like, yeah, get these things off my screen because, like, what is that? What is this?
They're like 400 vol, right?
Yeah. I'm not trading this. But when you backed into it and you understood the way how some of the other people were positioned and some of the momentum that was behind it. And when you started backing in and seeing some of the prints that were coming through, certain routes that they were coming through, you started understanding that, well, there's actually some institutional money behind this and there is some sort of fragility and, there's a good amount of reflexivity with people offside. So, we should buy right tail skew there, even though it was tremendously expensive, at one point. There are certain situations that warrant you to literally just position yourself in the tails. So that was a scenario that we did pretty well on in January.
But in terms of your overall thesis for when you started the group, was that there's anomalies, it's mispriced just on the left tail or both tails?
No, so we had this belief that you'll see this excess variance in the front of the term structure both ways. So we do believe right tail skew has this excess variance as well, but we do feel that, really towards where we serve is more so for protection for the clients. So
it's just more natural for the stairs up and the elevator down. Right?
Exactly. So we'll buy some right tail skew here and there, but that's not really what we're setting out to do. It's mainly to the downside.
And talk through this excess variance in the short term. So you're just saying it's like Corey Hofstein's liquidity cascades and that kind of thing, right? Of like once everyone starts heading for the exit, it's going to be swifter and faster than previously.
Yeah, exactly. And that's really why the way how we look at the book is it's pretty simple. It's focus on areas that give you the largest amount of delta notional that you're shelling out for your theta. Focus on areas that are leptokurtic, which means the market is mispricing and kind of thinking that this event can't happen, and really be positioned for the highest payout possible in the front of the term structure. I think what a lot of other vol shops do, which I personally, I kind of don't really like, is playing the 1 month to 6 month vol, 2-year vol as a tail risk fund. I don't think that that's really a good way to kind of play it when the market has shown you that there's so much fragility that when you get these unwinds, it happens in a very rapid movement. So what we said is, okay, let's focus on the highest payout that we could possibly get. Let's focus on the largest gamma that we could get. And let's literally just relock and load it by using absolute return strategies to offset the cost to carry. So if we have a few absolute return strategies in our back pocket that we use as traders, we could take that money that we make from there and fund the front of the term structure. So if we bleed on out, it's fine because it doesn't really matter. The money that we're making here, we fund there, and it's an ongoing cycle.
And the goal is to be roughly even if there's no outliers, or slightly positive or slightly negative, or what does
I would say the goal is to be slightly positive. We feel pretty strong about some of the absolute return strategies that we have in our back pocket for the longer process of time. So we would aim to be slightly positive, but slightly positive to slightly down. That's ideally that little range. that we like to stay in until you get one of those type of outlier events occur.
And then talk through me how you think about, right, when I hear like, oh, we're going for the biggest payoffs, we're going for, I'm like my 20-year-old self in the casino in Vegas, like trying to do the 30 team parlay or something, right? So like there's tons of things that have huge payoffs, but the odds of it happening are so minuscule, right? So how do you weigh that? Like statistically, it could, maybe it will never happen, but it still has great payoff odds.
Yeah, so we also hold this belief where we remove our quant hats and put on our trader hats, where we look at the environment and we try to price things where we actually think is realistic. So even though, let's just say SPX 1800 puts for next week are quote unquote tail risk, that's not something that we'll be buying. So we run certain scenario analysis, and we run certain, like, what we like to call reflexivity tests, so we could have an idea, if we look at things from a Bayesian type of lens, if we look at it from like a Bayesian type of lens, to say, okay, there's condition A, here's condition B, and this is where the market is pricing condition C. If this happens, what's the probability of this happening, and then how does that affect the probability of this happening, right? So that's based on like certain things like positioning within not only dealer positioning, but who's holding the name, why are they holding the name, who are the larger agents in there. So having an understanding towards that, and then pricing it. So we're not buying, like I said, SPX 1800 puts for next week. We're trying to price things that have shown its face before, but the distribution has turned into a leptokurtic one, where the market is saying, no, that can't really happen anymore. But we've seen in the past that it has happened.
And just as a way for me to think about it, you're basically betting like there's the market saying there's a 5% chance of this happening. We think it's a 15% chance.
Exactly.
Like, and what do those numbers look like? Could it be a 1 versus a 2% chance? Or like, what's that spread you need in order to pull the trigger?
Yeah. So
without giving away the secret sauce, but is it a huge spread, a small spread?
No, so I would say that, when we have an idea, or I would say a positional imbalance, where we know that, hey, if this happens, it's giving a 15% chance for this happening, and if it happens, then this is actually not a 1 delta, but it's actually a 12% chance.
Yeah,
we'll look at that and we'll say, okay, well, where can we get the best value? And then we'll start looking at pricing, and we'll start looking at the amount of delta notional that we could get. So as an example that I use, the actual theta to delta notional, that's a big kind of like little spot check ratio that we do, where we say, for easy math, if we're shelling out $100 worth of theta, we want, if it gets to that strike, the delta notional to be 1,000 times. So we want the 1,000 times the theta that we're shelling out to be the delta notional. So if we could get that wing with that value in a leptokurtic distribution, in a scenario that we have seen previously from its old distribution that has happened before, we look at that, and you overlay a positional imbalance, we look at that and we're like, okay, that's a win. That's good value. That's where we should be seeking value, as opposed to, yeah, let's buy downside puts in the ARC names, or the tech names.
Yeah.
Where it's like,
yeah, just it's like an advanced version of the value trap, though, right? Of like, I'm getting, right, you spend 2 years of like, I got tons of value, I bought everything cheaper than I thought it was worth, but if nothing pays out, you're still like left holding the bag. But that's why you have the other component, right?
Mm-hmm. Mm-hmm. Yeah.
Not to be too much of a gambling addict, but I come back to like the Calcuttas, where you buy the teams in the March Madness,
Mm-hmm.
And I actually came up with a little model, and I assign a value to them, and you're in the live auction, and at the end of the day, I'm like, oh, I got these 10 teams all at a lower value. I got them in the auction at a lower value than I had them in my sheet. And then all of them lose in the first 2 weeks, and you're like, oh, I still had great value, but I didn't get any payout. Mm-hmm. But that's just options, right? That's just part of it.
Yeah, I think the other thing too is to think about like true implied beta. What will carry the heaviest beta during a sell-off? Because what's different to the scenario that you're laying out, as opposed to like financial markets, is that when things go down, right, correlations come to 1, the entirety of the market is going to come down. So it's like, I use this scenario talking about that, the Big Short, when you think about what Jamie Mai did, from Cornwall Capital, where those guys bought the AAA tranches instead of the, triple C, because they understood that, well, if it's going to fall apart, we might as well seek out the best value, because when things go risk off, the entirety is going risk off.
Yeah.
So, where can we hoard this best value when correlations do come to one?
So then you're buying as much of this as you can, offset the delta, with an eye towards, we don't want to buy too much because we have to cover that bleed. So talk through the cover the bleed side of the book, as you call it, which is, you show your trader roots every time we talk, and you talk about the book. Most other managers are like the strategy and the models. You're like the book.
Yeah, for sure. So we look at it in terms of coverage. So we run like our daily shocks and slide values. So, we run through certain like historical scenarios, and we take like an average on that. And we just want to make sure that if this scenario occurs, is our book really going to return X amount? Are we positioned to return 300%? Are we positioned to return 400%? And look, you can't be 100% sure on these type of things, right? You can only forward project so much, because it's just how the market works. But it gives you some sort of a frame or an idea as to know like where you're at. So we kind of assess the vol landscape, and we'll say, okay, how much funding do we need this month to make sure that the book is positioned well? So that's obviously based on vol pricing, skew pricing, VIX pricing, yada, 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 equity vol pricing. And then we'll come to a number, and we'll come to a budget that we have. And, let's say the budget is 2% or, 1.5%, whatever it is. We'll look at our short volatility side, and we'll say, okay, well, this is how much we need to cover. How much VAR are we putting up for the short volatility book? And then we kind of pair those two off together, and we say, okay, this should cover this. If we lose double both ways, this is how much we're going to lose here. This is how much we're going to lose here. And the beauty of what we do, everything is risk defined, right? So you don't really have to worry about like basis breaking, which are standard type of relative value vol trading, where you could have something along the lines of where, maybe say the basis breaks and this goes up and this doesn't move up fast enough, or a calendar or something like that. And then your risk is just completely thrown off. Everything that we do is somewhat like risk defined. And I think this goes back to our type of like trader mentality that we have at the firm, where we look at it as like, okay, trader first, which is manage risk first, and then quant after. So that's really the focus is, use some of these absolute return type of strategies to mitigate the bleed. So, when we are doing well with the absolute return strategies, the portfolio looks pretty.
But those are actually selling vol.
Mm-hmm. So, our core strategy is a capped short Vega, and I just want to reiterate that, right? It is risk short volatility strategies, and we have a few derivations where we're running a longer holding period, and two, we have a medium frequency intraday strategy that we run for the short volatility stuff. And then we are actually rolling out a special situation strategy that my partner's been trading for quite some time now. So we're pretty excited to roll that out next month, because we think that that's just another absolute
and that's
return.
Inside the absolute return. So that would be like, hey, earnings is coming out, we can position such and such a way.
So this is a little bit different.
Well, not the new program, but just in the current program in terms of the absolute return, because you have some special situations in there, right?
So this is a little bit different one. It's basically uncorrelated to vol. It's an absolute return type of strategy that's a little bit uncorrelated to vol. I'll tell you when we get off of this one. A little bit proprietary.
Okay. But so, and just to reiterate that, because right, you're a tail risk fund. You said earlier you're long vol, but here you are selling vol inside of it. So how does that work? Capped versus uncapped?
Yeah, so I think, statistically, I say this all the time, statistically, the right side of the trade to be on is really that short volatility side, when you look at the stats behind it. But what most people do incorrectly is that they do this in a uncapped type of way. So you have situations where correlations go to 1, or, maybe you're short a straddle or something like that, or, you're short an upside call or something, and you just get blown out because your risk is not defined. So what really we look to do in our book is we look to define the risk on our short volatility stuff. So we cap the risk there, and we leave our long gamma stuff uncapped. So if VIX were to go to, like 100 or a million, it doesn't matter to us because the short volatility stuff gets capped. And then the long volatility stuff that's uncapped will obviously pick up, convexity and skew and get going.
And it's capped by just you're selling a call maybe and buying a further out call.
Yeah, pretty much. We could be a short stock on a name or something like that, and long a call, or short a call spread on a VIX ETP. We have certain derivations of strategies that we run that way, but pretty much it's all risk defined where you have
risk defined spread off.
Yeah.
And so then the danger is like some sort of pin risk, right? Of like if it hits the short side right up to that capped amount, but the long side doesn't move at all. That's where you could lose on both sides.
Exactly. So like as I was telling you before, so January we had a really good month where we were able to buy right tail skew in some of these names, and our book did well. But a month like February or March, if you look at those type of environments, a fund like ours, we're not doing great numbers as people would think, as like, oh, you're a tail risk fund, well, volatility moves up a few points, you should be up. Well, that's not true.
Yeah.
Right? That's not true. And if you see most vol managers, like they kind of replicate the same type of like belly risk, I call it, where what happens is that if volatility moves up a little bit, right, it starts moving up, you lose on your short Vega stuff. But if it doesn't have follow through, there's no pickup in the wings. And if there's no pickup in the rings, then you run the risk of losing both ways, where you lose on the short Vega and you lose on the wings. And this is why we like to reset our risk and be thinking about max risk, because we know that belly risk happens. So if it does happen, how much are we going to lose both ways, right? We don't want a scenario where, we wake up one month and we're down like 5-6% for our book. Maybe for other people's books that's okay, but for our book in a monthly base, we don't like taking on that type of risk.
So, right. So both, I want to cap the short volatility, but then if I'm admitting that there will be times where I'm wrong on both sides, and make sure that risk is acceptable level.
Exactly.
So you got me thinking, I'm going back to the convexity side. Like, how do you square put skew? And in theory, those are overpriced because of put skew and other people buying those wings, right?
Yeah. So I think when people think about like value in vol, there's so many different ways to look at it, right? Like I could look at something and I could say this is cheap, and another guy could look at it and he could say that this is rich, right? Depending on, okay, how are we analyzing this? Are we comparing, this equity vol to SPX vol? Are we, comparing the 10 delta put by, the at the money put? Are we going on a 2-year look back, a 5-year historical look back? Like, how do you define rich and cheap? So our way of defining it, and I've heard some people say this too, where obviously, when you think about equity vol skew, the wing is going to carry the heaviest vol, right? So if this is trading at an 80 vol or something, somebody may look at that and they'll be like, oh, that's trading at an 80 vol. How do you, like, what makes you think that that's cheap? But my way of viewing richness to cheapness could be different. I could be looking at that wing and I could be speaking in terms of actual theta to delta notional in the rest of the equity vol space. So one thing that we don't do is just buy SPX puts or SPY puts or something like that.
Yeah.
We try to be very creative in the equity vol land based on these positional imbalances, right? So we'll figure out what has a positional imbalance, why is it there, and we'll try to buy skew or kurtosis there. So
give an example of that. So you'll go into individual, like the energy ETF or something like that.
Yeah, preferably the names. Like we do have some ETFs and stuff that we carry on the book, but we enjoy actually buying the names, because if we could have a good idea as to, okay, is there a positional imbalance there? Who is really the main participants in the name? What are they carrying? If there is a risk off scenario, will they be unloading? It could give us a better implied beta number to look at and say, well, this could really get to here. Right. So as opposed to you doing that, if you're doing that on SPX, is so much white noise going around, right? It's it's so much of that it's really hard to refine it. So when you think about equity vol and you're thinking about value, well, I know who the main market makers are in this name. I know who the main holders are in this name. And I know who, like the large participants are in this name. So I know that if this event happens, there's going to be a deleveraging in this name as opposed to SPX, right? Like,
and by the event, that could be a new Iraq war, a pipeline bursting, whatever, or are we talking major market event, right? Like, to me, the danger in that strategy is, so what I'll ask first, what do those betas look like? They're over 2 or they're 1 point something?
Yeah. So
Negative,
it depends. It depends. It really depends. There's a variance that carries in there, and we don't hold the actual beta number too heavy because obviously, it's a flawed way of looking at things as well, right? You can't say, but our implied beta will have an assumption based on that. But yeah, that's why we like to spread it out as well, right? We're not completely locked in on one sector where we're saying, for example, some of the healthcare vol that you see right now in the equity vol land is pretty cheap. Like Pfizer's, if you look at Pfizer's skew compared to the rest of the actual equity market, like downside protection is pretty cheap. So do we want to be buying all of our exposure and all our convexity in Pfizer and healthcare? No. So, we'll buy a little bit here, we'll pick up some here, and we try to be creative on the ECNs as well. We'll figure out, where some of the algos and, what market maker wants to get an order done and things of that sort, so we could get the best value. And then, we'll try to diversify the book a little bit as well.
But as a mandate, so then it's the S&P could be down 30% and the few names you're in or the many names might not deliver, or vice versa. S&P maybe barely moves and those names deliver.
Yep.
Right. So that's a little, which we talked before, like this basis risk. So there's a little basis risk there on the downside.
Yeah. Hence why you try to diversify a little bit when you're buying those type of wings.
And I always think of it like a mustache, right? Like a reverse mustache, right? So that belly's where you lose and then the wings picks up.
Yeah,
right?
Exactly. Yep.
But you're saying it's a little more skewed to the downside. So it'd be like a tilted mustache.
Yeah, that way. Yep.
You should grow one of those, be like a handlebar. So you can be on pod and be like, okay, see, right here's where we might lose money. Right here's where we pick up.
No, you know who took that over, man? Corey Hofstein ran with that for a while. Hopefully he's listening to that. He became the king of that mustache.
Of the handlebar?
Yeah.
That's not a good look. We mentioned the dispersion. I called you the Duke of dispersion. Like, just explain quickly what you mean by the dispersion trade.
Yeah, so standard dispersion trade would just be like, you are, let's say, short some sort of index vol or ETF vol, and you're long the components inside of it. So, you could replicate this to a straddle where maybe, you're short the straddle on an index or ETF, and you're long the straddles on the components, and you could do this like delta weighted or vega weighted, depending on what really your appetite is. But pretty much that trade loses when correlations come to 1. That's really the bad part of that trade, is when correlations come to 1.
It's betting on dispersion within the index, right? That these certain names are going to move a lot more than the index itself.
Mm-hmm.
If you're long the dispersion trade, if you're short the dispersion trade, vice versa.
Yeah.
And so you essentially are a dispersion trade, right? Because you have those single names on the downside and not necessarily the index on the upside, but.
Yeah, we used to do a lot more flavor of relative value and dispersion early on. That was something that we engaged in quite frequently. But as we started looking at our book and what we could deliver to clients, we thought that there was just better value in kurtosis and skew trading. We thought, as in relation to like what we do and what we're good at, we understand that landscape a whole lot better than a lot of other people's. We understand when certain things are getting triggered through the ECNs. We understand why certain people need to get order done. Who are the people that are getting the order done on those certain things? So we started saying to ourselves, well, what is, yeah, sure, we could be positioned and play relative value vol. We could still trade dispersion and stuff like that. But where do we offer the biggest value add for our clients? And that's why we kind of just gravitated solely to just say, just focus more so on the kurtosis and the skew trading.
And what would you say to like, well, surely like Citadel's got a room full of people that are getting the same information on where the positioning is and the who needs to get out of the trades, all like basically everything you just said. Like, what does that look like of who cares? We can both do well in this trade, or is that a competition you need to win? What does that look like?
Well, one of my partners is the next Citadel guy, so hopefully he's doing their stuff. No, I think when you think about that area of the market, it's like the wild, wild west. So there's not too much competition because it's very hard to play the wings. A lot of people get discouraged by it because it's constant losers. But I think people who understand the dynamics and think about things from a mathematical perspective will understand the value in there. And if you understand things from a mathematical perspective and you understand that option pricing is just naturally flawed because it's going off of, backward looking false stats. And you also understand that, well, the environment is showing you that there's so much like variability and excess variance that's taking place in the market. It's a good place to be positioned in. So when you add all those things together and you think about like, well, it's really the wild, wild west because not too many people like to make markets in there. Not too many people like to be buyers there.
So it's just, we're saying it's too niche basically for these big firms to go down that rabbit hole and get into the, like, what do the volume look like in some of the wings?
It's light. I mean, especially post-COVID, right? Pre-COVID, you definitely had a good amount of wing sellers that were just looking to, just generate some sort of a yield. But post-COVID, it's like nobody really wants to be playing there. So when you do see something there, and I could give you guys an example, it could be something as simple along the lines of like, let's say you're seeing on screens a market maker has a position that they need to fill where they're long an HYG put spread. Let's say, a 10 by 5 delta, and I'm just making that up just for, argument's sake. They're long the 10 delta put, right? Short the 5 delta put. So they're better sellers of the 5 delta put, right? So if you're a wing buyer like me and you're able to spot that, you could kind of go on screens through the ECNs, you could kind of, put your bid out there and pull it a little bit and kind of see, how they would react, how would the algo react, and maybe you could get a good feel on that because naturally they want to be better sellers of that, but you don't need to buy, right? We don't have to buy that. We're not forced to buy that. But if you want to come down to our bid, we'll take that if it's the value that we're seeking.
And so speaking of all this flow and dealer hedging, we talked on our GameStop episode a lot and just talk through, if you could, like what now versus whenever that was, January, with all that craziness versus 5 years ago when you were at BMO. Like, have we seen a phase shift to all this dealer hedging?
When you say that, you mean like, is it stronger now?
Yeah, is it stronger? Is it moving the market more? Is it right? Are we going to see more and more GameStop type scenarios? I guess just talk through what you're seeing in the current dealer hedging space.
Yeah, so I don't know about the GameStop scenarios directly, mainly because I think it offered a very unique opportunity where people were receiving their pandemic checks and people were still in this pandemic environment where they wanted to trade. And I think all of those things just lined up for the retail trader to have a really good push. And then the Reddit crowd was just, very together. So it just added up for this big bang. Not too sure if we're going to continue to see things like that, where a Reddit crowd just comes in and moves names. I know they've been trying on a few other names and it just kind of hasn't really been working. So I think that may be losing its steam. But when you think about the reflexivity and some of this impact from the dealer hedging, it's still there. I think just that GameStop and AMC thing was just a little more emphasized, but there are certain scenarios where you will see these events keep happening in single stocks. A one big event that a lot of people kind of forget was Tesla's rally back towards the end of 2019, when Tesla had that huge run up. A lot of that was some dealers that were just offsides because people were just buying Tesla calls. Dealers were short, and I think a lot of people underestimated how far that could go. Now, don't get me wrong, there was a lot of momentum and there was a lot of other factors behind that, but the dealer hedging absolutely did emphasize that. So I think we will still see events occur throughout, the time going forward in single stock land. And I've been so, I've tried to emphasize this a lot with people when they're thinking about value. Like, you should be thinking about it in like single stock land, not just the SPX complex, because sometimes that like gamma hedging, it could be very impactful for single name vol. But I think we'll continue to see that going forward. Maybe just not to the extent of where you just have this whole like Reddit community just completely engulfed finance.
It seemed for a minute there like this was all that mattered in the markets. Like, no, all you need to know is where the flow is, and then right. But that seemed a little too simple at the same time.
Exactly. Yeah. Exactly.
Yeah. So if you had put a number on it, 1 to 10, the power of that dealer hedging in shaping the market, where would you throw it?
So in that scenario, I would say 10. I would say the GameStop scenario, that's as strong as you'll see, because it was just so many things just lining up for, big momentum, big flow, other buy side guys, and, prop desks looking to take advantage of it, and dealer hedging being offside. It was all the ingredients for a big boom. Going forward, I would say that from 1 to 10, relatively speaking, from, I don't know, maybe the last like 10 years, I would say it's probably going to be at like around a 7 or a 6-ish.
Okay, right. Because there's people that we both know, right, of like, that's all that matters. Like, throw away your quant models, throw away your values, right? Like, the flow is all that matters. And then there's people on the other side, which I feel like are getting left behind a little bit, that are like, it's all quant. Like, none of that matters. Just have your models on the prices. And it seems like you guys are in the middle. Like you're saying, trader first, use the models to inform.
Yeah, absolutely. Like, we're understanding that models break all the time in financial markets, and we're never too locked into any one of our models or any type of pricing model of that sort. We try to take a step back and understand the environment, and, we use our trader hat to put on our discretionary side, but we also have, the quant-based math models that we carry as well, whether we're looking at things and, like I said, from a Bayesian standpoint and pricing things out, or, if we're thinking about things from a mean reverting standpoint, using like an ADF test or something of that sort. So we use the models, but we don't let it fully dictate the trading. We try to keep that middle ground balance.
And now I got to ask you, your one pinned tweet is your motto is live, breathe, eat, sleep, trade. That's all there is. Like the NBA to me. So that's a little like anti-millennial. You're also a millennial, right? So millennials get this bad rap for not wanting to work too hard, yada, yada. You're the antithesis of that. Getting up, what do you get up? Like 5 a.m. or something?
Yeah, I'm a pretty weird guy when it comes to things like that. I'm generally up around sometimes 4:30 a.m. I'll take a check-in of markets. I'll go to the gym with one of my best friends. So we train, we take it pretty serious. Next thing I'm back on screens, and I'll work for the entirety of the day, evening time, just catching up on stuff. Like I said, we're still a new fund and we're growing, and there's a lot of things that need to be dealt with on the infrastructure side. So, handling those things, going through strategy calls and whatnot. But I truly love the game. Like, there's nothing else I'd rather do. Like, I promise you, if you pay me $5 million more to go in the NBA, or, $10 million more to go be an NBA player, or I just wouldn't take it, because there's just something about this game that just excites me from a mental.
You could do this one for the next 60 years also.
Right? Yeah, that's true, right? The longevity in it, but it's just something that I love. Like, you could pay me less. I mean, you could pay me less, tremendously less, and I would still want to play this game. The money is just a booster that comes with it,
There you go. Get your fee discounts. He said you'd pay him less. Not really. But do you think like you can outwork the competition? Is that part of your MO? Like, hey, I'm gonna hustle more. I'm gonna outwork them. And can that work in like a markets environment, right? Like for sure in the athletic sphere, you could out hustle someone, but there's always going to be someone with more computing power, with more quants, with more, what do you think
Yeah.
about it?
Yeah, so I think that's just my personality. I'm a person that kind of prides myself on having like a really good work ethic. So I embrace work. Like if you give me a tougher challenge, I will appreciate it. So like the tough stuff in the gym, this tough stuff that I've had to deal with when, you know, being a trader on Wall Street or a junior. Like I mean, man, there was when I was at this one fund, I had to wake up at sometimes 1 a.m. because we had to be at the office during earnings season at 2:30 a.m. to go through sell side research. Like I've walked that path already, you know, like I know what it was like to work at Home Depot and, you know, work at Walmart building construction. And I mean, shoot, there isn't a job that you could tell me that I haven't worked. So the hard work, it's something that's just been like embedded in my brain per se. So I enjoy it now that I'm older and, you know, it's not really that hard work. You know, I look at some of the people in the community that I come from and I look at my life and I say, well, if the hardest thing that I have to do today is trade and, you know, be on 7 calls and a strategy call and code up some stuff and, you know, go to the gym compared to what they have to deal with, that's not a tough life at all.
Yeah. That never works with my kids when I tell them that. Like, hey, stop whining. There's kids without an arm or a leg or this. And they're like, yeah, but it really hurts. I'm like, all right.
Right.
But I appreciate the sentiment. Well, keep doing it. You're killing it. You're doing great with all the hard work. So let's finish with some favorites here. Favorite New York City restaurant?
Oh man, I was not expecting this. Oh man.
Out of the 6 million, right?
Favorite New York City restaurant. Oh man, I know I'm gonna take some heat from the partners on this one.
We'll come back to that one if you want.
No. I'll hit it. I love Lamani. I love Lamani. It's Lamani. Damn, people are gonna be like, man, you're a bougie Wall Street guy. Like,
yeah.
Lamani. No, I really like Lamani. I think it's a good spot. That's my favorite spot, actually.
Where's that at? I don't think I've ever been there.
Man, I don't remember the address. It's right in Midtown though.
Midtown, yeah.
Yeah.
Favorite gym in the city? Do you go to a few or you just have your one?
So I prefer the boxing and jiu-jitsu over the weightlifting, but if I had to like do the weightlifting stuff, like if that's where we're going, I would say I don't like any of the gyms in the city like, because they're so packed. They're so tremendously packed at all times. Right.
You're not going to go like Equinox or some that would double down on your bouginess.
Yeah, no.
Speaking of the boxing and the jiu-jitsu, favorite MMA fighter?
I'm gonna have to say Gregor Gillespie. That's one of my training partners. Really good dude, by the way. Shout out to him. He's probably not even he won't listen to this, but
hey, Gregor.
But he's a good dude, good fighter.
And he actually competes. He does well.
Yeah, he's actually ranked in the top 10 in the UFC right now.
Ooh.
Yeah, dude's a really good fighter.
I don't follow it at all, so I apologize. But favorite New York area casino? You've been known to go test your math skills at the casinos, right?
Oh man, yes. New York area casino. I have none.
Well, I'm like including up to Foxwoods and whatnot, right?
Okay, so Mohegan Sun. But I will say my skills at the casino are not good because I'll go there and I'll count cards for 8 hours and I'll make $100. So I've made a vow to myself that the next time I go to a casino, I'm actually just going to go gamble because this idea to just go there and use math and count cards for 8 hours and make $100 is just, it's not fun.
I always wonder that too, of like the big hedge fund guys that are in the World Series of Poker or something. Like, surely there's better uses of their time. Like they just want to win. They want to beat the game, right?
Yeah.
But their average earnings their hourly earnings is quite small. Favorite book on investing or vol? You mentioned a few earlier.
Whoa, that one is definitely tough. Investing or vol? I have so
Both.
many. I have so many. Trading Volatility by Bennett, Positional Option Trading by Sinclair are two really good books. Dynamic Hedging by Talib is a really good book. Man, I have a ton of vol books. I don't even know if there's a vol book that I didn't read. But when it comes to like the old school guys are gonna appreciate this. The new school quants are gonna hate me for this, but Reminiscences of a Stock Operator is just my favorite. But man, that the mentality behind that, the trader psychology, I just highly suggest it to all new traders to just really embrace that. Like some of the lessons I think about to this day, like I'll give you a quick little thing. There was this one point in time in my career where I was trading really good. And I was really looking at the market in that lens of like, yeah, don't worry about it because I can make money next month. You know, my payout next month is going to be great. And it was that crazy confidence that I had. And the market will always humble you once you start thinking about it in that term of like, yeah, it's a piggy bank or an ATM machine. And you know, Livermore talks about that with him wanting to buy his wife a coat or his wife wanting a coat and making bad decisions to really fund his lifestyle. But yeah, that book, it really builds pillars on the core trading principles that I think every young trader needs.
Yeah, you're joined like 30 other people have always that's for sure number one amongst the when I asked that question. So in good company. And last but not least, favorite Star Wars character.
Yeah, I'll go Obi-Wan.
Obi-Wan. All right. I made you Ezra Bridger in the infographic.
Yeah.
You're like, who is that?
Yep.
Obi-Wan, wise beyond his years, little ambitious, hard worker. I like it.
Obi-Wan. Yep.
You got any robes?
No robes. No robes.
No robes. All right, Kris, it's been fun. Best of luck to you. Go enjoy your Friday night. Back to the gym. You're gonna relax?
Yeah, probably get something to eat. Back to the gym tomorrow morning.
Nice. All right. Good luck to you.
Thank you so much, Jeff. Appreciate
We'll talk soon.
The Derivative is brought to you by CME Group. CME Group is the world's leading and most diverse futures and options exchange. For more information and educational resources about futures and options, visit cmegroup.com.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you.